This final chapter before the quiz, Chapter 4, analyzes the shapes a yield curve can take and examines the classical explanations given for why a curve has a particular shape at a given time. In general, three theories are used, often in combination, to explain the shape of the yield curve. For the rest of this chapter, the curve generally referred to will be the zero coupon curve. We name them first and analyze them afterwards individually. These three theories are the expectations theory, the liquidity theory, sometimes called the term premium theory, and the preferred habitat theory. Disputes continue to this day regarding the relative accuracy of these alternative theories and the extent to which any of them correctly explains the shape of the curve between any 2 points. We can only summarize in the briefest of ways the principal arguments for and against each theory, and point you to the thousands of pages of academic and professional research on this topic if you are hungry for more. We turn first to the expectations theory. This theory states in essence that the shape of the curve reflects market expectations regarding future interest rates, and specifically that an upward sloping curve reflects expectations of rising rates, a flat curve reflects neutral expectations, and an inverted curve reflects expectations of falling rates. Certainly in cases of a steep upward sloping curve, or one that is significantly inverted, particularly at the short end, research confirms the accuracy of this theory to some degree. Simple polling of economists at those times regarding their interest rate forecasts, which are then compared to the forward rates implied by the curve, show some reasonable but not perfect correlation between these two items. Flattish curves are also generally consistent with neutral expectations regarding future short-term interest rates, but again, no perfect correlation is observed, nor should it be expected with something as complex as the yield curve. Interestingly, on the few occasions when the curve has been extremely steep at the short end, rates have in fact usually proceeded to fall instead of rising significantly, as implied by the level of the forward. But instances of very steep curves are really too rare to generalize much from observed precedents. The liquidity or term premium theory is one we touched upon earlier, and states that the longer the tenor of the instrument, the greater should be its expected return, all other things being equal. This results from investors' preference for short tenor assets, and specifically ones with low price volatility and or which can be turned into cash more easily than others, either by selling them into the secondary market at close to their par value, or in a worst case scenario, by holding them until maturity. Thus, under this theory, even when interest rate expectations are neutral, we should expect the curve to be upward sloping to some degree. Otherwise, no incentive would exist for extending maturity and thus assuming greater price risk and lower asset liquidity. The fact is that over the last 50 years, say, U.S. short-term interest rates have moved within a wide range starting in the late 50s at lowish levels, then rising pretty steadily throughout the 60s and 70s, and then peaking in the early 80s above 20%, before beginning a more or less continuous decline into the new millennium and hitting bottom, of course, in recent years. We might conclude from this pattern that on average expectations have been cumulatively neutral, despite, of course, extended periods in which rates were expected to be rising or falling steadily. And yet, the curve has been upward sloping some 90% of the time during this half century, suggesting some evidence of a term premium in bond yields, i.e., some evidence of a higher yield on account solely of the extension of maturity. Please note that the two factors we have analyzed so far can sometimes neutralize one another to some degree. In a market in which short-term rates are generally, let's say, expected to fall, and yet preference for low-duration assets is significant, the first factor would cause the curve to invert, as we have learned, while the second factor would cause the curve to slope upward. And if these two factors are of roughly equal impact, the curve, of course, could end up being pretty flat. The third and final theory, the preferred habitat theory, correctly points out that certain investors, especially regulated institutions, are often attracted to one particular point or range within the curve and repelled by another point or another range for reasons different from the quest for yield, including regulatory factors, tax factors, accounting factors, legal factors, among others. Suppose, for example, that pension funds are severely penalized by the law if they find themselves underfunded, which means roughly that the market value of their assets is materially less than the present value of their projected liabilities, which liabilities they tend to view as very long-term in nature, particularly in the case of those pension funds whose customers are predominantly young and healthy men and women. A fall in long-term rates therefore pushes the present value of these liabilities up quite measurably, given their very long duration, and therefore an excellent hedge for this problem is obviously for the pension fund to purchase very long-dated bonds, even when the yields on these are substantially lower than they are on medium-term bonds of comparable credit quality. While economically the medium-term instruments may offer the higher expected return over the long term, the risk of reducing asset duration and finding oneself underfunded following a steep decline in rates is often too great to be contemplated. This pushes the pension fund out as far as possible along the curve, causing the long end to invert substantially in some countries. In a market in which frictions of this kind are non-existent, this would be unlikely to happen. But virtually all markets, even in the most capitalistic economies, do impose some significant frictions on their pension funds, on their banks, and on their insurance companies, among others. An example from the opposite end of the curve involves money market funds, central banks, and even corporate treasuries, who, due to pressure of a political or regulatory nature, or sometimes due to the preference of the credit rating agencies, often tend to keep their cash invested in treasury bills of the very shortest maturity, even though a slight lengthening of maturity could result in a yield pickup of some 25 or 50 basis points annually or more. In turn, this causes the shortest end of the curve to slope upward significantly, even when interest rate expectations are neutral or even are inclined towards lower rates. This completes Chapter 4.